If I showed our pension portfolios to most advisors or ran it by an AI model, they'd probably tell you it's wrong. With just around 5 years from our expected retirement date, we have nearly 42% of our pension sitting in cash. Now, I've said in the past, we invest on the safe side, but is 42% of our pension sitting in cash a sensible choice? Are we making a huge mistake, or have we got it about right? So let's have a look at our current portfolio percentages. We have 43.36% in equities in developed markets. So that's mainly the UK and the USA. Next is the big cash and cash equivalents position. That's sitting at a massive 41.73%. Those two make up the majority of our portfolio at just over 85%. So the remaining 15% or so is made up of emerging market equities at 3.67%, government bonds at 2.99%, high yield and corporate bonds both at 2.55%, gold at 0.85%, private equity at 0.43%, and then others at 1.86%. So that's our full breakdown of our current asset allocation in pensions. Perfectly normal, right? If once you've watched this video and want to add your own pension asset allocations to the comments below, then I'll get a good idea of what is normal. So back to the large cash position and our explanation for it. Well, we added quite a sizable chunks to both our pensions over the late summer and early autumn. These were from our savings. I wanted to push them into our SIPs to gain the additional tax relief of 25% from HMRC. So making my money work better as I approach retirement. These savings have been sitting there ever since in either cash or overnight money market funds. I'm quite happy with the mix at the moment. However, if there was a substantial pullback in markets, then I would consider putting a portion of this into a tracker fund. I thought our current portfolio asset allocation was heavily skewed in cash. So I wanted to find out what was normal for a couple in our position that's about 5 years away from retirement. AI models should be good enough for them as they scour the web for reference material. So here goes. I asked Grok, ChatGPT, Gemini and Claude all what they thought would be the correct portfolio allocation with just 5 years to go until retirement. First up, Grok. It said 52% in developed market equities, 6% in emerging market equities, no cash. Yes, really, no cash with 5 years to go to retirement. 25% government bonds and 17% in corporate bonds. So quite what I'd consider a riskier mix there, with 58% of the portfolio in equities. Next up, ChatGPT. Now, it is the most thorough of the AI models and puts a figure for all the categories listed. It suggested 35% in developed market equities, 5% in emerging market equities, 8% in cash, 30% in government bonds, 12% in corporate bonds, 3% in riskier high yield bonds, 5% in the risk averse gold, and 2% in private equity. So that's just 40% in equities and most of the rest in safer style assets. I would say that's a very balanced portfolio and one which should not cause too much shocks approaching retirement. Now on to Gemini. It went with 40% in developed market equities, nothing in emerging market equities, a large 15% cash holding, 25% in government bonds, 15% in corporate bonds, and, like ChatGPT, a 5% holding in gold. So again, that's just 40% in equities. Maybe our position at 47% equities is not far away from the normal. And finally, Claude has suggested the following: 30% in developed market equities, 5% in emerging market equities, 10% in cash, 35% government bonds, and 20% corporate bonds. So that's the most conservative model regarding equities at just 35%, with the rest in more stable holdings. But even with it being the most cautious, it doesn't suggest a gold holding. So now we compare our current holding with the average from these AI models. So our current total equity position at around 47% is actually just above the average, which is just over 43%. Now, that was a surprise to me. If we got a substantial market downturn, then I would probably add to our equity position. Is this the right decision? Because looking at the AI models, they suggest we already have enough in this asset. So now onto our huge cash position. It's nearly 42% and way above what the average suggested at just 8%. So where should we put the majority of our cash? Other than the minor discrepancies in the smaller allocations, the average from the AI models suggests we should put it in a mix of government and corporate bonds. So should we do this? As far as I see it, cash is broadly similar. Okay, so cash is based on the instantaneous overnight rate that you get from your SIP provider and also overnight money markets. Whereas bonds, you can push the time frame out to like 5 years or 10 years. But I basically don't see much difference. So what do you think? Drop a comment down below with what you would do in our position with a huge cash pile. Would you buy equities straight away, or bonds, or, like us, leave it in cash? And if there was an equity market downturn, would you then be buying the dip? What are your current portfolio asset allocations, and how far are you away from retirement? Or if you've already retired, then are you playing it safe with your portfolio, or are you staying invested in equities? If you've enjoyed this content and are not yet subscribed, then please consider doing so, as in a short while, I think it'll be February the 1st, we'll be revealing our next monthly retirement numbers, which we're now calling our retirement tracker. And we'll show you the full breakdown of the gains and maybe some losses over the month. Oh, and while I remember, this monthly retirement tracker will be a newly designed spreadsheet with tons of extra features, including growth and inflation, along with a great feature for people who are considering downsizing their house. I've just finished it today and it took me ages to construct, and I am absolutely blown away by it. It is amazing. I mean, I say that myself, but it is really, really good. I just can't wait to show you guys. I did have help on the growth and inflation figures from Grok. The other AI models just couldn't compute the formulas correctly, and they are damn complicated to say the least. And as it's a Google Sheet document, I'll have a link in the description for that video so you can download a copy for free, so you can enter your own numbers for fun. Okay, that's it for now, and I will see you in the next one.